Welcome to the latest episode of Damien's Market Update, which is the show where I talk about what's been going on in investment markets and what to look out for in the days, weeks and months ahead. Now, the last time that I produced this show, stock markets were riding high while bonds were slumping, just as we saw the possible beginnings of a Trump trade 2.0, which was reminiscent of the market movements we'd seen back in 2016. But a lot has happened in the last month, with most of the catalysts emanating from America. So we had disappointing US tech results in the second half of July, which dampened investors' appetites. But as we moved into August, the release of two US job reports on the 1st of August and the 2nd of August sparked a stock market sell-off that characterised the first half of August in its general trend. So these reports revealed unexpected weakness in the US job market. So that triggered fears of a rapid economic slowdown and a possible US recession, which caused US and global stock markets to tank. Now, investors' jitters were compounded by the unexpected rate hike from the Bank of Japan, which strengthened the yen and sent Japanese equities into a downward spiral. So by the 5th of August, the Nikkei 225 suffered its worst one-day loss since Black Monday in 1987. And that meant it actually fell 12.4%. So as investor anxiety spread globally, the US stock market's fear gauge, which is the VIX, spiked to levels not seen since the COVID-19 crash in 2020. Now, the epicenter of the fear in the stock market was the Japanese equity market, as I've mentioned, but also US tech stocks. Now, the Nikkei 225 lost over 17% in just 2 days, dropping 25% below its recent all-time high. So that actually means it entered bear market territory, with a bear market being classified as a fall of 20% or more from a recent high. Now, the severity of the sell-off in Japan can be attributed to the unwinding of the yen carry trade. Now, the yen carry trade is a popular strategy where investors borrow yen at low interest rates to invest in high-yielding assets, mainly US Treasuries, stocks and bonds. Now, this strategy has been profitable as long as the yen has remained weak and Japanese interest rates have stayed low. And that's been the case really since the early 1990s. Now, the Bank of Japan's rate hike disrupted this strategy, leading to forced selling and then the unwinding of the carry trade, which caused a ripple effect across global markets. And what we saw was the sell-off hit global equities, but particularly tech stocks. And that's because they have received significant inflows from carry trade funds in the past. Now, the timing of this unwinding happened during the summer, when trading volumes are typically lighter because of holidays. So when traders go away, you tend to get this very volatile period. So anything that happens is normally amplified. Now, analysts have been debating, or had been debating, the potential scale and impact of the carry trade unwind, but there was little consensus of how much was left to still unwind. But it did all mean that in the first 2 trading days of August, that while the Nikkei 225 had, as I mentioned, slumped in double figures, most stock markets fell about 3% to 7%. Now, fast forward to today, and stock markets have staged an impressive rebound, with most indices, with the exception of Japan, returning to positive territory for the month. Now, strong US retail sales and lower than expected inflation data in the US calmed recession fears and fueled hopes for a US rate cut in September, reviving that Goldilocks narrative of balanced growth as well as inflation that has been tamed. Now, gold has unsurprisingly now been propelled to new all-time highs thanks to those US rate cut hopes. So if you've got gold in your portfolio like I have with my 50k portfolio, that's welcome news. Now, seasoned investors will know that strong stock market rallies often follow significant sell-offs, which is what we saw in the first half of August. So, for example, after the Nikkei 225 dropped 12% in a single day, as I mentioned, it rebounded 10% the next day. These sharp recoveries are known as short squeezes, which occur when investors who have been betting on further declines are forced to buy back stocks, driving prices higher when the market starts moving against them. However, short squeezes are not always a sign of a new sustained uptrend. Markets can still roll over and hit new lows. But for now, the market angst that we've seen at the start of August has subsided. So, for example, if you look at this S&P 500, it has reclaimed a critical technical level, breaking out of a month-long downtrend, and that's providing a foundation for potential further gains. Now, one thing I can say that after returning from a brief trip away with the family, I can genuinely recommend taking a break during a stock market downturn. Now, that might seem counterintuitive to those people who like to check their portfolios regularly, but stepping away could prevent them from making rash decisions which are driven by panic and market noise. Now, research suggests that such a strategy could benefit not only their mental well-being, but also their financial health. If you go back to some research I carried out for 80/20 investor members in 2015, I conducted the research to look at what would be the best strategy to help navigate a stock market slump. Now, the findings indicated that while there is no foolproof strategy, history suggests that staying invested after a significant market correction is often a better choice, partly because of those rebounds that I've mentioned. Now, reacting impulsively instead to market declines can lock in losses and cause you to miss the subsequent recovery. Now, this is precisely what we saw in August. We found ourselves in a slump following a slow downturn that started roughly about a month ago. So again, not panicking was a sensible strategy. So in those scenarios, what you should do, well, there's been some valuable lessons that we've learned from August. Always be cautious of consensus narratives. Avoid panicking and making emotional decisions during market sell-offs, but instead refocus on your investment strategy and long-term goals. And remember that short squeezes often follow those major sell-offs, and those who panic can miss out. But finally, what I would say is maybe take a holiday during those market slumps to give you some much needed perspective. So that is it for this month on Damien's Market Update. As ever, if you've enjoyed it, do hit that like button, but also subscribe to the channel.